In order for a business to get to that spot where it's doing over $1 million in revenue, it's got to have good systems, processes, people, like resources, so that when you take it over, you're not wearing every hat. You're the CEO.
There's good value in your business. Some people don't realize how valuable their business even is until we really give them an outline to say, hey, we went through a valuation. This is what we paid. It's actually worth this now. So yeah, I think it's interesting, but people really should go through a valuation, even if they're not selling tomorrow. Hey everyone, welcome to the Manage to Exit podcast. My name is Aaron McElhiney. I'm the Executive Director of Acquisitions here at Property Management, Inc.
And I'm Hunter Goodall, and I am the equivalent of Dwight Schrute.
Not a fair.
I plan on just slipping in as many office references as I can.
I know last week we spoke kind of with our first episode, diving into a little bit about what we do here. And I thought this time we would chat about some recent transactions, a couple deals that closed in the last month or so, each around a couple $1 million each, and thought it'd be good to share some details from those deals just for people that are looking at maybe selling their business or even buying a property management business. It's kind of fun to share as much of the details as we can about the deals we do here in-house.
Yeah, it's we have two in mind that we recently worked on that I'm pulling up the information right now as we're talking, and it's really interesting to see the difference here. One of them was a public listing and one of them was an off-market deal. And just brief summary for those who don't know, like multiples is a phrase that you hear a lot in acquisition space, right? And it's usually referring to when you're valuing a business, there's a lot of variables that go into it. But basically, what's the net, the financial benefit that the owner gets for owning that business? What's the multiple of that number? And that's where you get your valuation from. And then all these factors of the business determine what you should pay, what that multiple should be, right? Usually it's 2 to 4 times SDE, seller discretionary earnings. However, typically, and we tell this to people all the time, the better deals are going to be your off-market deals that come through relationships. I'm looking at the multiple on this one deal that just closed. The multiple on this one that was a public listing, 4.38 versus the off-market one, and they were both very similar sized. The off-market one was 3.8. So that's half a point higher. That's a big difference.
Yeah, let's talk about why. And I think with the public listings too, just through the years, I don't know if we've done less than 5% of our transactions as being public listings. Primarily, we focus on the off-market deals, but I mean, let's talk about public listings and why they usually are a little higher, right? Maybe, broker fees is probably a good place to start. What do you think? What's your experience with brokers?
Yeah, good and bad. There's always going to be pros and cons, right? The good thing about public listings is they're ready to go. Typically, that broker got involved and talked to the seller through the process and got the business ready to go with, getting all their financials, all their due diligence docs that the buyer's going to need. They pretty much got that all ready to go. But the broker's going to charge 10 to 12% of whatever that sale price is. So it's like that fee's got to be included and baked into that purchase price.
Yeah, and usually we see it posted a little higher too, right? We're kind of guessing that they're probably building a little bit of a buffer to say, hey, they're probably going to need to counter and maybe meet in the middle, right? They might get a lower offer. And so they're starting a little bit higher, but sometimes that expectation with the seller is kind of thrown off by that too, right?
Yeah. Yeah. The seller is expecting a lot. But then here's the other thing. I took a screenshot and I've sent you that screenshot before. There was a public listing that I looked at on a Monday morning. And within like 2 days, that listing I took a screenshot. It was like over 1,000 views. And so it's like out of 1,000 views, people that viewed that business that was for sale, how many of them sent a message to the broker saying, hey, I want more information? Like at least 50 of them.
Yeah,
and so now
or Biz by Sell, I think they put that on there, right? Like how many views? Mm-hmm. And it's usually in our space, it's like hundreds, if not in some cases. in some top tier markets, you might see 1,000 plus people, like you said, looking at one deal. Amazing.
Yes. Now you're competing with 50 to 200 other buyers. All of you want that business. Well, the deal's probably going to go to the highest bidder. You're in a bidding war. And so that drives the price up. And then there's no way you're getting any kind of terms on these. It's going to be an all cash at close deal because one, the broker wants to get his fee right out the gate. But two, if you're not willing to pay all cash at close, one of those other 200 interested parties, they will, right? So
And how many times, I mean, I can't even think of how many times we've been able to talk to a seller directly from a public listing before being forced to send an LOI or send an offer, right? Brokers won't even let us chat with their sellers until there's an
why
LOI
not?
in place, right? There's no relationship into that deal at all. And the terms are already laid out there, right?
Yeah, it's like half the time you get to talk to them, and I've come across a public listing that I submitted. The deal just got posted that morning, and I submitted a request for it, and the broker got back to me, and he's like, "Hey, sorry, this one went fast. It's already off the market."
Yeah.
So it's tough to win those. They're priced really high and, really competitive. You gotta be pretty fast on those, so,
Too many buyers
um
and probably too many unqualified buyers, right? Like I've heard, can't remember what business broker it was. I want to quote it from Mike Shea, but I don't know if it's from him. But I think he said something like public listings being for people that don't know what type of business they want to buy yet. It's just for people that are looking at being an entrepreneur, want to start something, maybe don't want to start at ground zero. But for people in our space, people that know, hey, we're going to buy property management businesses or sell them, the off market space is just where we live and breathe. Right. I mean,
yeah.
it's for focused, industry focused individuals. They know that they can do deals off market. They don't need to publicly list. They don't need to go use a business broker, to get a good price for their business. But yeah, I'm trying to think of those two deals and like how they differ when it comes down to portfolio size and team size. Like that's a huge value add to a lot of these transactions. Like what kind of team is in place? And so yeah, maybe we could speak to that a little bit too.
Between the 2 deals, the revenue was about the same on both of them, very close. I mean, hovering around that, like, 1.8 to 2,000,000 revenue size, right? And, yeah, they were cash flowing 4 to 550,000 in that range on average, so you know, looking at them, I'm like, "These were very similar deals." Very similar, except
Good margins on both, right? And one thing,
Mhm.
maybe just to talk about similarities, both of those businesses had consolidated multiple PM companies over the last few years. So that's something that's pretty interesting. A lot of people in our space, they buy out the mom and pop shop that was operating for 20 plus years. Both of these recent transactions that sold for around 2 million each were consolidating, three or more
Mhm.
companies there locally. Just kind of interesting to see that we're always part of that buy side and that existing kind of add value scenario. And I'm going to keep rolling here. The exit piece is super interesting, right? These were companies that were being built to sell, and I think 3 years old at the oldest, maybe. I think both have been operating for around 3 years. Is that about right?
The current owner was about 3 years, right? The business itself had been around, the portfolios had been built up over, 10 plus years, but they went and did that small consolidation effort where they were, buying these $300,000 businesses for, maybe 1 or 2 times cash flow on these. They packaged it together, and then our buyer comes in and they say, "Hey, yeah, you've been running this for 3 years. You pieced all these businesses together. We wanna pay you 2,000,000 for it." And now our buyer wants to go do the same thing, and we're gonna buy a couple of $1,000,000 businesses that we can sell for, I don't know, 5, 6, 7,000,000, right? And
And both of
it's
our
kind of a
buyers
fun game.
Yeah, both of our buyers were already in the space too. So, you know, there's a lot of add value with those mergers. It's not to say the buyer was brand new to the industry and they had to just build off that platform. Both of these deals were essentially mergers. So yeah, just a different position. I think regionally, totally different markets. The portfolios, they were across the same kind of similar industries, residential and association management. But the differences being, there's some much larger communities, let's say in the southeast versus the northeast, right? On the association side. Not a lot of large associations tied to that northeastern transaction. I think, some of the community sizes were smaller, even 20 to 30 homes in an association versus the ones down in the southeast. There's multiple that are 100 or 200 or more homes in some of those HOAs or communities too. So similar revenue, but totally different, you know, portfolio pieces when you look at unit counts in those associations.
I think one of my favorite things about the public listing, all cash at close. The off-market deal, how do we set that one up? Wasn't it 15% cash at close and seller
Yeah.
finance the rest? And
Yeah,
then there's
totally
a
different buy structures. Yeah.
yeah, but again, that only works if you have experience in that business. You've gotta have years of experience to really instill confidence that you're not gonna tank this thing, that you're gonna be able to pay that note. But I
Yeah,
think
for
my
sure.
favorite part about it is we baked in on that deal kind of this win-win scenario, which we could do because it was an off-market deal and the seller was financing it. But we said, "Hey, you're selling this because you wanna focus on another business. We believe we could help that business grow. If we do, we want a discount on the balance owed,"
Yeah. And
right?
I mean, only an experienced buyer would get access to that, to your point, right? With the off market deal, the seller worked with us directly and we were able to negotiate some of those pieces. The seller had enough confidence in our buyer. They're a great operator. They already had a great team in place. They've been doing this for a number of years. But yeah, if the seller doesn't have that confidence in the buyer, they're going to say, hey, I'll cash at close, is what it is. Go to the bank, get an SBA if you need it, whatever you need to do to bring the cash. But yeah, I mean, the seller liked our buyer enough, and they're a good fit, right? Just the cultural fit behind both of those. That's a huge question I get a lot too, right? Like, how do you identify and target these businesses? And we are looking for kind of these cultural fits beyond just the value multiple, right? But yeah, there was a big trust piece there in the off market deal that we got the chance to build with the seller that we just didn't really get that chance on the public listing.
Yeah, a lot of times to get off market deals, it does take time, right? It takes a lot of time to build up that kind of a relationship and to have that trust with somebody to be able to say, "Yeah, I wanna buy your business," and for the other person to be like, "I'll finance you because I have confidence in you." This one was kind of unique because I think I started talking to the seller in September, beginning of October, and then the deal closed in February. So we had to go through the valuation, building trust, due diligence, getting funds together, all within about a 5-month period.
But that transparency though is kind of unique too. I mean, we don't want to waste anyone's time. The seller didn't either. And so everyone just outlined kind of what they needed. And then we brought a bunch of ideas to make it work. Right. But I think what was interesting with that, and like I don't want people to think that, hey, you can get 80, 85% seller financing on every deal.
Not
I would
common.
say pretty rare. If we get, 25% to 50%, hey, that's great. But a lot of our deals we offer and put different structures together. Sometimes we're providing like an A and B, A being all cash at close and B being more of a seller finance model. And so we provide those options, realizing like, hey, we've got good banking partners in place um, that our buyers can take advantage of if they need to. But some sellers will be upfront about that, and they'll say, "Hey, I need this cash to go into this next business. or, hey, I'm willing to finance because it's going to be a heavy tax year for me. I'd rather spread this out, for different reasons. So yeah, like I think that flexibility is only there in the off market deals. Any public listing we've worked on, I'm pretty sure it's just been
Always.
90% or more cash at close.
I think it's more fun doing the seller financing ones when you can investigate, like, you're building a relationship with these people. And so many times people think, hey, when we sit at the negotiation table, it's me versus you. And it's if you can change that mindset to think like, hey, what do you need? What do I need? Like, can we get on the same side of the table here? Like, let's figure out how we can both get what we need. And it's part of that is figuring out what is the seller doing next? That first not the first deal, but one of the big deals that we did out here in Arizona, in Scottsdale, that was I remember that was part of the conversation. We were like, "Hey, what you're selling this business, you're still a pretty young guy. What are you doing next?" And he was like, "Oh, well, my wife and I wanna do some e-commerce business." And
Yeah.
so our initial deal structure, we were like, "Well, what do you need to get by every month while you're building that?" Like, what if we set up this deal so that we're covering all of your living expenses while you're getting that off the ground?
Yeah.
And it was kind of a cool structure, and we started going down that path for a while, but then they decided to just take the discounted cash at close.
Yeah, and like to your point, a discounted option, like it made more sense for them at the end of the day. And we went to the bank at that point, and that's a fair option for us either way. But maybe we could talk about the time to close too, right? Like the seller finance piece without getting the bank involved, obviously moves a lot quicker. Our cash deals usually require the bank to spend at least a few months, getting that deal together. But yeah, I think we could probably talk about the speed to close with a seller financed option too, for maybe a seller that does want to make a move in like 60 days. Like, how does that impact financing?
Yeah, it part of my discount, like, psychology when I'm going through that is I'm thinking of the painful hurdles that it's gonna take to go through, like, SBA financing. SBA is great. 'Cause, so let's rewind on how that works. The SBA is not the one funding anyone's deal. It's whoever the bank is, but the SBA has their own set of diligence process because they're gonna tell the bank, "Yes, we will insure 80% of this loan." And then the seller or the buyer has to come in with 10%, so the bank is really only on the hook for 10% of this deal. But there's a ton of paperwork, it takes a ton of time, and
Oh
they're
my, yeah.
always it's like we'll send them this giant packet of all these documents that they asked for, and then 3 weeks later, we're like, "So, what's up?" And they're like, "Oh, we forgot to tell you, we need this now." It's like,
Right.
just keeps on going and going and going, and it takes forever. And so part of my discount psychology here is it's like, I don't wanna jump through those hoops. My buyer doesn't wanna jump through those hoops. We can get this done way faster if the seller is willing to be the bank, and we would rather pay them. Like, they'll make more money if they act as the bank for us. We'd rather they get the interest than the bank.
Yeah, I think some sellers gravitate towards that a little bit quicker than others, right? When they see the time difference, right? SBA could be 3 to 4 months. We've seen it a lot quicker before, but it's not something we want to overpromise on. A lot of our buyers have gone through SBA or other, small business products before. Some businesses are really a good fit for SBA. Like we've done a fair amount of expansion loans and working on one right now that has, an office building included with it. And so I don't want to speak too much about SBA and all the details, but I think that could be actually a really fun topic to maybe bring in one of our lenders and let them dive into it, and then people can hear from them directly. But yeah, SBA does take time, so it's a good fit. But if someone's looking to move a little bit quicker and is willing to, finance some portion of it. Doesn't need to be the whole thing, right? If it's 50% or 25% or 80%, who knows? Just that ability and that flexibility for the seller to finance can speed things up quite a bit. But beyond that, it also kind of gives the buyer a little bit of confidence too, right? It's like, hey, this seller's willing to work with me. They have a little risk in this. I have a little risk in this. It's actually, I think, a big confidence booster. Even if you could get 20% seller financing.
Yeah. Yeah, and usually I don't think I would start with like on an offer saying, "Hey, we're gonna give you 15% down." I don't know how we got that one to work, but it seemed to be a great fit for everyone. In fact, we didn't start with that. We started with, like 35% down, and then they countered and they were like, "Yeah, no, I'm okay taking less, but I want more balance." And we're like, "Okay."
Yeah, it's a
So
good
it
item for them to counter on, right? They can get a little bit more if they do take a little less down. We can keep that price a little higher in some cases. So yeah, I think they saw the value in that too. But like I said, and you mentioned this too, they were kind of excited about their next project and their other businesses, right? And so sometimes it's just a timing thing where sellers want to move quick and they're willing to finance more if the buyer can move a little faster too.
yeah, a lot of times it's speed. Oh, we have that one deal that we're working on in New York that's just taking forever. And a lot of that is because of well, there's so many reasons to that, but that one is going with an SBA product and it's going to be all cash at close. And so a lot of it has been like playing the game of, "Hey, SBA, we gave you everything you needed. Everything good?" And then we have to wait and wait and wait and then they get back and they'd be like, "Oh, hey, we want this now." "Okay, you got it." And then we wait, and they're like, "No, now we need this." But then another part was, I think the other the seller didn't quite have everything as organized as originally thought, and that has taken just so long to get through that process.
Yeah, and I mean, there's
Remember
other complexity to that one, right? There's multiple entities. But yeah, SBA. I think by the time if you've produced the documents they wanted, and if there's a 2 week span, then you need updated financials, pretty much. So I think the other part to that is working with someone that really does a lot of SBA, right? Working with a lender that has a focus team, even some of the consultants out there that only do SBA. I think we've worked with a pretty wide range of them. We definitely have a few favorites that we've done multiple transactions with too. But yeah, the banking partner is critical. I think with this one, there was like maybe a local introduction and maybe not immediately familiar with the industry, but very familiar with SBA. We have some lenders that are overly familiar specifically with property management businesses and SBA products to help property management companies. So pretty interesting little niche. It's probably not easy to find those people unless you're doing a lot of transactions in the space. But yeah, SBA with that one's probably taking a little longer than most. I wouldn't say that was typical. That's probably a one off. I hope it's a one off, right? Fingers
No,
crossed.
it's been the longest one we've worked so far. Yeah, I think, the SBA though, it's a great product. A lot of people don't realize this, that it's available or how it works. Um, the SBA, again, they're insuring the note with the bank, and so the bank says, "Hey, the SBA requires that you have 10% down. Whatever that purchase price is, you gotta come to the table with 10% down." Where that 10% comes from, I don't think they really care. That could be your money, that could be, friends and family, other investors. We've had deals like that
Could be
where
a
the
seller note too. It could
yeah.
be.
So, but it's a great option, and so people tell me, like, "How much money do I need to buy a business?" And I say, "Don't don't worry about that. Find the business first. Find your deal, and then you'll be able to figure out how does this deal make money, and then what are my financing options on this, right?" And I'm always comparing it back to like what if I were to get an SBA note and I needed to find 10%, what does that look like? That's my BATNA, my best alternative for how we're going to finance this deal. And it's like SBA is the last resort in my mind. Can we find another way that still makes sense? And then I compare it back to my BATNA. What would my monthly payment? What would my rate be on a SBA product? So that's how I structure it. When I'm like structuring seller financing options, I'm comparing it back to that BATNA.
Yeah, but I think the big piece you kind of hinted at was like the sourcing piece. Like finding the money is not the hard part, like finding the right deal. And both of those two recent transactions, those are active buyers. They've been hunting for deals. They've been, I mean, one of them has closed probably 7 transactions um, in multiple states, across multiple states. And so yeah, I mean, finding the right deal. They've said no to a lot of deals too. So it's not to say, hey, those buyers just found one deal and they closed the one. It was probably the result of hunting for months in some cases to find the right deal, passing on ones that weren't a good fit. Maybe they were overpriced. Maybe they didn't like the portfolio or the management structure, or maybe there was too much risk in the portfolio. Maybe there was one client with 60% of the property spread. Like there's a lot of different pieces. And those were two that closed that were strategic buys. I mean, they were intentional. They knew that they could find the money to get it done. One went SBA, one didn't for different reasons, but both were able to close, which is awesome.
Yeah, it's that one that was in the Southeast, that deal. I'm pretty sure we reviewed like 3 or 4 deals the month before that one came up. Like we walked away just in 30 days before the one that they closed on, walked away from 3 or 4 of them just before. So it's like, yeah, you got to be prepared to look at probably the 10 deals to close on one, right? Sometimes we hit it lucky and we're just like, yep, we're closing on this and this and this and this. And I guess that's actually kind of the unique thing about us is with PMI, we can look at any property management business across the whole country. And, it could be a book of business that's really only worth like 50 grand, or it could be a 2 or $3 million business. Doesn't matter to us because we can look at it and we can say, no, this business isn't worth anything next. Or we can say, yes, this business is worth something and it's going to fit this buyer, but not that buyer.
Yeah.
Right. So that's kind of a cool thing that gets us so many of these at bats with these businesses.
Yeah. And I think just having multiple buyers in a single market is pretty interesting, right? I mean, there's some alignment that needs to happen with buyer and seller. Like we talked about, kind of that cultural mesh that needs to happen. Um, some of the portfolio splits that we've seen where, hey, maybe there's one buyer that does a lot more multifamily and that portfolio might fit their needs a little bit better. But you mentioned Southeast and kind of that recent deal. Some of the deals we had passed on down there were actually smaller transactions, right? They didn't have the team that we needed in place. Maybe not the best neighborhoods with some of the portfolios. And so I think a lot of people have issues with, what size business do they need to buy? And so that one down there was a larger business, had more team members, had, really good market share, I would say. And so they passed on some of those smaller ones because they were entering this market for it was a new market entry. So they didn't want to start with a platform that had, 100 doors. They needed something that had a team, larger portfolio. I think it's a little easier, and maybe you have some comments on this too, to sometimes start with the larger purchase, right? Some buyers think, oh, I need to scale up and, buy something with 50 doors, 100 doors, maybe it's 2 or 300,000 first before they go after $1 million transaction. So that's I know there's some heartburn around that. But let's talk about starting with bigger deals because I think it's actually a little more exciting too. So
Yeah, you're taking on more risk because you're gonna have to pay a lot more. It's not as cheap, but there's a reason for that, right? I remember walking through an example with one of our franchisees in Houston that he was like, "Well, I want to buy a $300,000 business. Walk me through the numbers. What does that look like?" And I was like, "Okay, well, you're gonna buy a $300,000 business. That one is likely netting somewhere around 85 to $100,000 a year. Of that, you're going to have debt service. So you're going to do all this work, right?" And I spelled out like, here's all the things that we're going to do during due diligence. And it's a lot of work. You're going to do all that work for a $300,000 business that you're going to get for really cheap, but you're going to have to take over a lot of the responsibility because that's what the owner was doing. And it's like after debt service, he was like, after debt service, I'm getting maybe $30,000 a year off of this. And I was like, yeah. Now let's do it on like a $1 or $2 million business that has more resources, more
Yeah.
people. It's got more revenue. It's a bigger system, and it's like, yeah, you're paying a lot more. You're paying instead of 300,000, you're paying 1.5 million. But at the end of the day, after debt service and everything, it's like, yeah, you can still walk away with, a six-figure salary from that.
You got that team though to build on, right? Now that smaller deal makes a lot more sense because maybe you don't need to staff up to take on that smaller portfolio, right? We talk about that all the time. Like, hey, what's the capacity of the current team? Like, how much more can they do before we need to hire someone there locally? What can be, utilized? Can we put some type of virtual assistant or remote team member in there? That's kind of the fun part. But I think a lot of buyers do think to step into that smaller deal first, just because they've never gone through the acquisition process. Maybe they don't have a team like us to like guide them through it. So it's just a little bit simpler in their mind to step into that small
Yeah.
deal.
It seems easier, but it's like we read that book, 10x is easier than 2x, right? And that book is great. It goes so well in line with what we're talking about here. Buying a 2x business, a $300,000 business, that owner is wearing every single hat. That business cannot afford team members to take off some of the workload. But a seven-figure business, same amount of work to get that one done as it is to do a $300,000 business, but that business has resources, it has better systems. In order for a business to get to that spot where it's doing over 1 million in revenue, it's gotta have good systems, processes, people, like, resources so that when you take it over, you're not wearing every hat. You're the CEO, right? You can step in as the CEO and not the technician, as the E-Myth would put it.
Yep.
So it's so much easier to do those.
Yeah. Team's such a big part of it, right? I think some of the businesses we've looked at that have had, great teams in place that would mesh well kind of with our culture that we have on the buyer side with PMI. Uh, like there's a lot of value in that. It doesn't always equate when we're looking at P&Ls, but for the clients to have, some familiar team members through a transition to a new buyer, like I mean, I can't think of a business we've worked on recently that we haven't kept everyone on, right? Like team is valuable. Like that's a huge part of why we do step into some of these larger deals because we don't want to go hire five people. We want the five people to already be there in that business. But yeah, I mean that's something that a lot of people should think about when they're looking at that $300,000 business and they think, oh, I'm going to have to. The seller said he's working 40 hours a week. That means he's working 65, and you're buying yourself a full time job, not really working on the business, but working in the business. And those bigger deals just give you that flexibility to maybe delegate a little bit more, obviously benefit from some of those ad backs that are potentially in the business, but also you're merging two businesses typically. And, for the buyer, there's some other advantages for them too.
Our franchisee that, we've done a couple of deals with them out here. They literally tell me like, "Yeah, we're buying the business because it's making money, it's revenue, it's got a good portfolio." No, the thing we want the team. We don't wanna go and hire and train new people. We want experienced people. We want the team who already know what they're doing. They're like for them, it's almost like it's easier to just buy a business that has team than to go out and hire and train a new person.
Yeah,
So
totally. And they've done all of their transactions pretty much in a single market too. And, you look at some of our buyers that are buying in multiple markets, where some of those resources might be used across multiple offices. In both of those scenarios, like we need people. Like it's still a very, you know, people forward business, property management. You can utilize some of those resources and technologies to simplify things, but a lot of our clients still want to meet with people and there's still on the, boots on the ground type work that needs to be done. But yeah, I think that gets overlooked sometimes. I've seen some smaller deals where they've had to hire pretty quickly, and the time and energy and money spent doing that, it's something you really gotta weigh out and see if that's something you want to tackle, or do you go after something and just target businesses that have that built-in experienced team already.
Yeah, I'm I'm thinking about our one of our franchisees out in Colorado that, you know, this is acquisitions is a great way to build out your business, right? He had you know, was he a one man shop? His business was doing about 200,000-300,000 in revenue.
Couple VAs, I think, couple remote team members. Yeah.
Couple of remote team members, but then he did a deal for about 1.5 million. And then he did
Yeah.
another deal a few months later for 1.7 million. Now he's got a business that has over 3.5 million in revenue that has a team structure in place that just instantly elevated him out of kind of like the property management seat to now I'm the business owner, I'm the CEO, and now he's got teams that are doing what he was doing before. Now he can focus on bigger picture strategies and building a system that's going to be more valuable later. So it's such a great way to acquisitions are just a great way to build your business. I think every business needs to have an acquisition strategy.
Totally. And I think just to speak to that franchisee, like his intent, even with the next deal, because he's not done, right? I mean, I think he's actively targeting a number of businesses, but he does have some goals around that, right? He's trying to get more out of the business than he is. The next deal coming along with, a general manager role, whether that's an existing team member that gets elevated into that spot or even a new hire. But, some of that cash flow from this next deal is intended to go towards that GM type role and, get that franchisee out of their business and letting them focus more on the fun stuff, right? On growing and adding value in other ways. So,
Yeah, it's interesting. Like I feel like the most successful business owners, like franchisees who are doing this, they're when they're buying businesses, they're not looking at them as, "Oh, I'm gonna increase my paycheck," right? It's like they set that ceiling for what they're gonna take home, and then anything above that, they're investing into their business. Okay, great. This business, if I buy this business, it's gonna add an extra $400,000 in cash flow that I could take home, or I could invest in building my management team to run the operation and take care of, I'm going to remove this off my plate and this off my plate. And I'm going to build up my team to now become a well-oiled machine. And that's really what it's about. So, they're looking at acquisitions in terms of like, if I do this deal, I can afford a president for my company or a GM, right? And so that's a great way to build up your business.
yeah. And we've seen that though, just thinking from the seller's perspective, some of the client relationships and services that those sellers have provided, not all of them are kind of up to speed with industry norms too, right? Oftentimes, a lot of these clients are actually benefiting a lot from this sale that happens. Right now, they get access to more team members. Now there are additional resources available to them as an investor. Right? Maybe they're getting access to some of the off-market investment opportunities, through our buyer. Right? And so it's there's two sides to that. Right? Some of these companies that haven't quite kept up to speed, a lot of things have changed in the last, even 5 years in this space. But yeah, to have, a business with good team members and good clients, um, that's a huge piece to the valuation, right? There's this kind of like art versus science of, valuation and kind of the goodwill elements tied to the client bases and employees. Sometimes that gets overlooked. I don't think we overlook that because we really need team members always. But just something interesting to think about, like not removing team members to show a higher net income. Like we've seen some sellers do that where they're just like, oh, I'm going to run it really slim because I'm going to sell in the next 6 months or 12 months. It's like we need the team that's there. If they can handle more work and you're a little overstaffed right now, like that's okay. Like we'll still we can show that value with you. But yeah, just kind of interesting perspective. Some people have different thoughts on that.
Yeah, my thought when I'm looking at businesses, because we've looked at a lot. We have like over 400 deals that we've looked at just in the last like 2.5 years, right? And I think about this all the time. When I look at a business that's running really slim, hey, yeah, we've got 1 million in revenue and we're walking home with, I've got 50% margins. I'm looking at that like, okay, you're operating too slim. You only have like 3 employees, maybe 2 employees, and then you're doing everything else. And I'm like, no, it's not a good sign. It's not a healthy business if the owner is doing everything, right? I want to know that, like, can the owner take a 2-week vacation? Does the business keep going if the owner's out, right, for 2 weeks? And if they can't, I'm like, "Ooh, there just went your multiple. Sorry," But a lot of times they think, "Well, yeah, if I can just have my cash flow really high and my margins look amazing, my business will sell for, 3.5x." And I'm like, "No, because if you're doing everything, that's less valuable." Like,
Right. Yeah, that's a tough one. Like you really have to ask some of those questions during valuation, right? And sometimes people underestimate how much time they're really spending on their business. And so, yeah, that's something we need to be careful about because do we have to include a salary for another manager, for example, right? That kind of hurts because also we need to go source, find that individual, hire them, in some cases, train them to some extent. Like it costs more than the $60,000 salary that
mhm.
someone in that role could have been taking, right? I think some of the industry projections are like a 25 to 35% loss as far as time and money goes for that new hire role. So yeah, I mean, it's easier for us to show a better value with the right team in place.
Yeah, like, there's been times that we look at a business that the owner and their spouse work in the business, and they're like, "Well, yeah, we take $200,000 each, or total for family income. That's SDE." And I'm like, "Well, no, because Jimmy is the one buying your business, and he can't do everything that you and your spouse was doing." Like you're both working 60 hours a week, and Jimmy can't do 120 hours a week. Like, he's got to hire someone to backfill that. And so yeah, the owner can't be responsible for doing everything. If the spouse or partner is in there, their salary has to be factored in. Somebody's got to replace what they were doing, right?
Yeah,
And
totally. Yeah, we run into
sellers
that
don't
quite a
think
bit.
that.
Yeah, that expectation that like that's why we like to talk to people early too, right? Like there are ways that you can really prepare your business to sell. Like what are buyers really looking for? You know, are there certain like high value items that they really need to prepare on that team being one of them? We talked about like contract assignment last time. And like there are a lot of things that we can guide people on, especially if they have that plan to say, hey, I'm going to sell in the next year or two. Like there's a lot you can do. If you're saying, oh, what can I do to, improve my valuation? I need to sell in 3 months. It's going to take a little longer than that typically, and it's also because you need to show 12 months of those improvements, right? Especially if we're going to the bank, and we need at least 12 months, after those kind of cleanup items or changes have been made. But yeah, it's not going to happen tomorrow. The value may not increase in 30 to 60 days. Let's put that out there, just so people don't kind
Yeah, it
of.
takes a while, right?
We gotta
And
talk earlier. Like, there's a lot that we can do. There really is. And that's why some of the deals we've done too, like I think about when I started doing property management business acquisitions, like it'll be 9 years in 2 months. And so there's a lot of people that we've helped sell and our franchisees have bought years later, right? Like we've been prepping people for their exits for years. And, I'm trying to think of, there's been more than a few that were 3 or 4 years, right? Where we gave them some guidance, we gave them a valuation, the number wasn't there. They said, hey, how do I get to a higher number? How do I get to X? I need to sell for 1 million. Like we've guided them on how to do it. Hey, you don't want to sell today. That's okay. Come back to us after you made these improvements and we'll get you to your number. So it's just an interesting play because that relationship piece, I mean, it's still like every month we probably have a conversation with someone that, was 6 months ago or a year ago or longer. And now that we just kind of got that idea planted with them, like, hey, there's good value in your business. Some people don't realize how valuable their business even is until we really give them an outline to say, hey, we went through a valuation. We did a $300 business in Tulsa this year. This is what we paid. It's actually worth this now. Um, so yeah, I think it's interesting, but people really should go through a valuation, even if they're not selling tomorrow. They should understand where their business is and then build a goal around it. Like build an exit number. Like what's it going to take to sell? And then, work towards that. But you do a fair amount of that coaching too. I know when you send out your valuation reports to a lot of people, sometimes it's just a reality check. But we also give some guidance too to say, these are the things you need to improve on before you exit.
I like to do that because there's been times that I'm like, yeah, your business, it's not quite there. Rather than us put in the sweat, you put in the sweat, fix it, and I'll pay you more later. And I'm happy to do that. I would love for them to do that, but I want to see the business look better. And let's use an example right now. We have a business under contract here in Arizona that I look at the financial statements on that, super clean, right? There's only been one item that we're like guessing, like, hey, can you give us a little bit more detail on this? But then we look at other businesses that they have all these personal expenses mingled in there. And it's like, man, how are we going to figure out what that bottom line is? And, we had one in California recently that the guy was like, no, I pay myself 500,000, 600,000 a year on this business. And I'm like, dude, the business only gross is like 800,000. How are you doing that? Like, but like, he's like, well, I hide all my personal expenses in there. And it's, oh man, trying to dig through these finances. It's like, no, clean up the books, make this look nicer. And that not only for us, it makes it easier for us to value. Like the deal that we're under contract with here in Arizona, they had clean books. And it's like, great, clean, you're organized. I like the way this looks. We're willing to stretch higher on this one, right? Versus the ones that are messy. Not only does the bank not like to fish through all that, they are not generous with their ad backs. Um, but it hurts the value because it's like it's telling me you're not very organized and it's a lot of guesswork. I don't want to have to guess at what that number is. So yeah, your value goes down.
Yeah, it totally undervalues like the real potential of that business. And yeah, it's like, how does the bank look at it? You mentioned that, right? Like we can see the value. Hey, you're going to sell or finance this. All right, we can walk through those ad backs and understand where our numbers are going to be. But to your point, the bank is not as creative as we are, and they're not going to take some of our projected values. If the books aren't within like a reasonable margin, right? Some of them have just crazy high margins projected, but they're not there in the financials. So yeah, and I think you're right though. That one in particular was interesting because it was a pretty large transaction. And I think this operator had just been like growing it naturally and kept the portfolio at a decent size, had team in place. Like he really should have started working with someone to prepare his business to sell because there's a huge value there. Now he's going to be, a year or more away to clean things up, maybe 2 years really to get where he wants to. So, but yeah,
Well,
that happens quite a bit. And I think people get siloed, they get busy in their business. And, they saw like something on Google that said their business should be selling for 6x or some number that doesn't really apply to their size business. I mean, we run into that quite a bit, right? Hey, this tech company sold for 20x. Like, like my, $200 property management business should sell for, whatever it is. But yeah,
yeah.
like I said, people should go through evaluation just to understand what the market's like. Get some comps. Like we have a lot of comps we share based on closed transactions. If we haven't done a deal in your market, we probably have a comparable market we could share on too. And just know what your business is trading at. And if it's not there yet, then how do you get there? And if that's going to take a year or 5 years, you better start on it now, right?
Let's just throw this out there just to set the record straight because a lot of people think they're like, oh, yeah, I heard businesses sell for like 3x. And they're like, yeah, so 3 times my gross revenue. So my business is worth $3.5 million. And I'm like,
No.
sir, back up. Your business is where it would take 15 years of me paying myself nothing to pay off that note. Like your business is worth like 800 grand at best. It's not a gross if you've got a service-based business, like, I'm not talking software, like not a tech company. You've got a service-based business. You're looking at a multiple on your bottom line, not your revenue, right? You can use revenue to find comps, but the valuation is not going to be like 3 times gross revenue. Like if you can get 2 times gross revenue, whoa, because that's wild. Like it's going to
Yeah,
be a multiple on the bottom line, not the top line.
totally. And I think like deal size has a lot to do with it too, right? I think, most of what we look at is a lot of sub 5 million gross, like sub 2, sub 3 million primarily. And so there's definitely a range to those multiples, but you know, that kind of 2 to 4x space is where a lot of these transactions are landing. I shared a whole bunch of closed deal data with Peter Lohman, who's, I think I'm saying his last name correctly. Forgive me if I'm not. Um, his pretty, I mean, I'd say well known. It does a really great newsletter for the residential, actually real estate services in general, but a lot of the residential focused PM side of things. And I shared a lot of closed deal data with him just to compare to. I know he's putting a lot of that together based on other transactions outside of our space. We have 400 plus deals to reference, so that was easy. I gave him a small sample. I don't know, it's probably less than 100, but across our brand, across multiple states, I don't know if those deals were in like 30 or more different states. That 2 to 4x space, 2 to 3.5 really was the majority of those transactions. And like I said, those are a lot of the sub, $2 million deals. So, I think there's a lot of transactions that happen in that space, not just in our PMI group, but across the industry. A lot of, it's a small property management companies. But yeah, that those multiples are always difficult because I think that's what people ask a lot. Like, are you guys offering like 2x, 3x? What? They just start there. They don't. You really need to define X. What is your EBITDA? What is your cash flow? What's your seller's discretionary earnings? Like, what does that really include? So a lot of it is kind of hand holding through that process, and it's good, right? Because people need to know and not to kind of set false expectations, but also to set like appropriate goals, right? Like, if you're trying to hit an exit number, then this is what a buyer wants to see, right? So I think we do a fair amount of that. I know you do. And I know, there's always a handful of those calls every week. But I mean, like monthly, how many do you think you kind of walk through that process?
Oh man, how many a month? How many valuations do I do a month?
Probably
I
track
couldn't even tell you. Like
pretty
I should
great
probably look
data.
at that.
We could pull the data. Yeah. Well,
But it's like people will ask me. I'll be on the calls with them and they'll be like, just ballpark it. Like what kind of multiples are people going for? And I'm like, oh, solid question. 2 to 4 times. 2 to 4x,
huge
seller
range. Yeah.
discretionary earnings. And they're like, dude, that's a huge range. And I'm like, yeah. Yeah, it's a huge range. Let me dive deeper into this because I'm not gonna just like,
Yeah. We
oh
need
yeah,
to
your
rip.
business is yeah. They're like, well, I have 1,000 doors. What kind of multiple should that be? And I'm like, probably, a couple Uno cards. I don't know. Like we gotta dive into it to really give you a solid answer. Otherwise, it's we're gonna say, yeah, your business is worth a 3x, but maybe it's worth like this one in Southeast that we looked at that they ended up with a 4x, right? Maybe it's not a great shape and it's worth 2x. Like I can't tell you without looking into it. The financials, looking through the financials, that's the science of the valuation. But then there's so many other variables. Like talk to me about the team. What are your roles? What's the market look like? Right? Like, it's kind of interesting. We're looking at a deal in Oregon right now and another one in Virginia, and it's like their rents are going down and their vacancies are going up. Like people are leaving, the population is decreasing there, and you know, that's a threat to the business right now. It's not just your business that we're looking at. It's like what's the market look like right there, right? So there's so many factors in every deal.
Yeah. Every deal's probably a little different. It's interesting to say that because we look at some that share the same door count in the same market, totally different revenue, totally different portfolio, org charts totally different. Like we do really need to walk through that. And for some sellers too, because obviously there's some confidential information that they share with us. We go through evaluation, we sign NDAs. Like we do get some of that hold back to say, what's it? They ask what it's worth and then don't want to provide all the details, right? All the financials. So, I mean, all of that information is confidential. We sign non-disclosures. These two sets of eyes right here, Hunter, you and I, we're the only two that look at these. And then if someone at that point goes through valuation, they're comfortable with the price range that's provided or the price tag, they set a number in place, they want to talk to a qualified buyer, then they have a separate non-disclosure or confidentiality agreement, with that buyer. We share information with you. That's it. It's all confidential. And if it goes nowhere and you're like, hey, I'm gonna go build some more, great, right? None of that is something we hold on to. It's just confidential between both parties. We offer that as a free service. And if I say that on here, I think we're gonna be extremely busy with people sending it.
Thanks, Aaron.
I mean, we do that quite a bit. I'm trying to think of, just myself alone, it's probably 2 to 4 businesses a week, of all sizes, right? We closed one recently that was 29 doors, small little portfolio. We actually closed one on Friday that was just under 400. And that was like a combination of home watch and residential. So just kind of a variety of different businesses. But when you look at valuation, it really, in the PM space, there's like all these different areas of PM, right? There's commercial, there's association, HOAs, condo associations, short-term rentals, mid-term rentals, which until a few years ago, I didn't know what that was. But mid-term rentals that are, that really got popular, I think, out of some of these super saturated STR markets. And then home watch, right? Which is something we're now diving more into. And you'll see certain regions that have more like kind of home watch service property management companies. So yeah, they're all a little bit different. And unless you talk to someone that's got experience going through these transactions in all these markets, like you might be getting too generic of information, something you might Google, and it's not giving you maybe the true value of your business. So that might be my warning, is to say, like, don't undervalue your business either, right? Like get a fair valuation done on it and, put those expectations there. But yeah, I mean, it's a lift. It totally is. But for us, it's like, it's a trust builder. Like we're in this for the long haul. And, if it takes a few years for you to build and come back to us, then hey, that's all good for us. So.
Yeah, it's interesting. I've come across people that they were hesitant about sharing their financials with me, but it's like we're not operators. I don't have a property management business that I'm running. Like, what am I going to do with this information? I'm going to give you a valuation, kind of a ballpark. If I were the one buying this business, this is what I would pay for it. But other than that, it's like I'm not using. I don't share this information with the other departments at PMI. I don't share it with franchisees. I don't give it to anybody. It's like just me and you that look at this until the seller says, like, I'll do the valuation. I say, hey, this is kind of where we would come in at. What do you think? Do you want to meet our buyer? And they say, yeah, that actually sounds great. Yes, let me meet your buyer. And I'm like, great. Can I share all this information with them? And they say, yeah, let's go. Right. I don't share anything with anybody until the seller gives me the green light to introduce somebody into the conversation here. And so everything stays confidential. And yeah, we do this a lot. Don't try to Google what your business is worth. Right? You're not going to get an accurate representation. I don't even know if my friend ChatGPT could give a.
Yeah.
I mean, I don't know. I actually haven't used ChatGPT to assist me on any of my valuations. I feel like that might be a breach of like NDA. I can't really share that with my friend Chat. Now I'm really curious. I'm like, I wonder what would happen if I ran some of these through Chat, see what he says. But yeah, we've done this a lot. We really know property management acquisitions. We have so many of these comps. Every time I send out a valuation to somebody, the last page is like, hey, here's like 12 comps that match your business. And here's another like 12 comps that are similar sizes. Like we have so many comps to lean on.
Actually, I've seen this too. I've seen business brokers kind of posting their closed deals, and it's always across like 10 or 20 different industries, right? I think one thing that might be really cool, and I know we're starting to do that on the acquisitions website, PMIacquisitions.com, to show some of our past closed transactions. And, that list is going to continue to grow. It'll be really cool to put more comps on there. There's the deals that are on there are all pretty recent transactions, but as we close them, we're going to keep posting them on there so people can see, here's what a closed deal sold for in what market. Here's the revenue. Like, we'll share as much as we can without giving confidential information away, but those are just on closed deals. But I really think that website's going to be a huge success. Just the amount of content we'll be able to share on there, the valuation tool that is on there already, where people can go in, put in some calculations on their business to provide a range. That range also includes an invitation to get, you know, more detailed information, to do a stricter, valuation process with our team. But it kind of takes some pressure off that. If you're just looking to get super high level and maybe want to know that number before you talk with someone on our team, that's an option. But like I said, I don't want to undervalue anything like that too. So it'd be great for someone to go through that tool, understand a range on their business, and then work with our team to really hone in on, the true market valuation for their business. Yeah. I'm just going to keep pushing people towards that website. Is that a
Yeah,
fair?
it's
Can I keep plugging
we've
that in?
we've spent years developing that tool, the valuation model, and Kyler, our guy in the chair, has really put a lot of work into building that out, putting it into our website. We specifically made it so that it does have kind of a wide range. Like that ballpark, it's a big ballpark, right? But for a reason, because like what we've been talking about, there's so many variables that go
Yep.
beyond just the financials. And it's like, okay, that's kind of our starting point. Now jump on a conversation with me and let's see if we can narrow that down and get you something more precise. Oh, and by the way, we have someone that would buy that, right? Which is kind of an interesting thing, and it's not self uh self motivated. It's if you're thinking about exiting, like we would love to help you achieve that goal. We've got someone right now that is willing and ready they're capable. They're capable operators. They're capable at getting the funds together to buy these businesses. And it's a win on both sides. The seller gets what they want. They get to exit their business. They get a nice big paycheck. Our buyer gets to, change their family's life where they were doing 300,000 in revenue and now they're doing 3 million in revenue. It's like it's just a great process. So,
Yeah, I think there's still a lot of people trying to get kind of familiar with our model and how we're not brokers in this. We're not listing your business. We're just connecting you with a qualified buyer. In some cases, we have multiple qualified buyers in the same market. Like, I've had to do this before where I said to the seller, hey, here are the 3 buyers. Here's a quick background on them. This is what their current portfolio looks like. This is what team they have in place. Like, who do you think your clients would work well with? And maybe that's the first conversation we have. So, I mean, ultimately, it's the seller's choice to, what buyer do they want to work with? If we have multiple buyers that are qualified and can do a deal of that size and we're confident in their ability, we just give the seller options and say, hey, oh, maybe they might even know that local buyer from, NARPM. There's a lot of, NARPM contacts out there where, oh yeah, I've seen him at meetings. He's great. Yeah, I like what he does. And so they can choose at that point. But we do pre-qualify our buyers. We're not going to introduce someone that we're not 100% confident in, that either has the money or could get the money through the bank. And so yeah, it's just it's a unique position. I don't think there's other people out there doing what we're doing.
we just went through that in Florida. Working a deal right now that I introduced. We introduced one of our buyers to them, and our buyer, they're qualified. They can operate it. They can get the funds together. But when they met buyer and seller, the seller came back to me and was just like, "Yeah, it wasn't really a fit." And so, we talked about it. And we are like, "Well, we've got another one." Like we've actually got another one that could be a good fit. Let's get you guys introduced. So it's kind of we're in an interesting position where it's like we start off working with the seller, but we disclose to them like hey, full disclosure, I'm helping you out for now, but at some point I'm switching over to the buyer side of the table. But it's like we're doing the valuation. It's just us working with the seller. Hey, this is kind of the fair market range for this business. This is if I get my buyer in here, this is what I'm going to recommend they pay for this business. What do you think? And if they say yes, now I switch over to the other side of the table and I'm like, hey, do you want this business? They've agreed to these terms. I want you to go and meet that person and you guys see if you're a fit together and you want to do business together. It's such a cool model.
Yeah, there's gotta be that kind of fit, right? People need to get along, and that's why we push people to an in-person meeting, like, as soon as we can. Like, "Hey, is it gonna be a good fit? Hey, we can figure out the number side. That's fine, but, like, hey, why don't you 2 go meet, talk about the team, talk about, the clients. Maybe there's some good overlap there." So, yeah, that is a big part of it, you know? It's, uh it's glorified matchmaking. I think that's what it is.
Yeah. We're gonna get one of those Netflix documentary shows now. One of those game shows.
Yeah, it's a little bit of that, but I mean, it's fun. It's fun for me. I've enjoyed doing this, and we just try to find a fit. If it's a good fit, great. Hey, if not, hey, that's okay too, right? We shared some information with that seller about how we work and where we think their business is, and at the end of the day, if they take that and go grow it or build it, or maybe sell it to someone that it's a better fit for, hey, that's okay, right? So the transparency on our side, like, years ago, I thought, hey, how cool is this? We do this in house. It was like a secret weapon, like, we know we have all this data behind these deals. And we've just realized, like, the more we share, like, the better these businesses are for us to buy too. So, like, we're going to keep pushing out, our practices and how we view things. And hopefully that helps people, prep their businesses to sell. And, but yeah, in the end, like, we want people to have a strong exit, get paid for a good business. And, we want our buyers to grow too. Right. So yeah, it is an interesting piece. Like I'm trying to think of, anyone else in other industries that maybe have this um, kind of platform. But yeah, it's a little different, but it's pretty exciting. Like, I think the market for PM or management specifically, right? Like, there's all these other ancillary businesses that kind of touch property management too. So we do primarily property management, but I would not be surprised if we start stepping more into what we've talked about, like these ancillary, the cleaning companies for the short-term rental, maintenance. We've done some maintenance and construction too.
Landscaping.
There's so many different pieces to property management and kind of aligning industry businesses too. But yeah, more to come on that. I think maybe on another episode we could do an ancillary business. Buy this business to contribute to your residential management company or whatever it is. That could be fun.
We could literally talk all day about this stuff. Like, this is I think I annoy my wife sometimes because I'll text you. She'll be like, "Hunter, stop texting Aaron. It's like 11:30 at night." But I'm just like always just like, "Hey, I've got this idea," or like, "What do you think about these numbers that I'm looking at?" Like, we're just constantly doing this.
If I don't respond, that means, dude, I'm too tired to hear about your great ideas today. Like, check on me tomorrow. But yeah, I mean, I think it's still kind of untapped. And I say that a lot, right? Like, hey, we're barely kind of scratching the surface. I think our whole industry has, it's been improving. I think businesses have gotten smarter. I think valuation has gotten stronger too. But yeah, I mean, we'll have to think about even some more topics to dive into, maybe beyond the typical property management business acquisition. I really like that idea. The maintenance piece is the one that's stirring in my head right now quite a bit. And the cleaning companies, which a lot of our short-term rental offices, we've done a couple of them already, but that's one underserved. So yeah, for another episode for sure.
Hey, thanks for joining us. Hope this was helpful. Again, this show is not for us. This is for you. We could talk about this all day. Make sure you leave your comments in the comment section below. Ask your questions so we make sure that we answer those on our future shows.